The City of Southport Board of Aldermen Special Board Workshop, March 1st, 2023, is now called to order. Thank you all for being here today. Those who are attending in person, our board, our city staff, our consultants, our county city manager, Mr. Stone, thank you for being here. Our public, our citizens, and those watching virtually. I would like to call on Reverend Alderman Lowe Davis for our invocation, and this will be followed by our Pledge of Allegiance. Please stand.
Let us pray. Creator God, we thank you for the blessings that you've bestowed upon Southport, and we ask today that you guide our thinking, open our minds that we may make good decisions, open our hearts that those decisions may be kind. Amen.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you, Reverend Davis, and we open our minds and our hearts today, so thank you. The next item is the ethics statement, and unless any of the aldermen are in the water or sewer business, does anyone have any conflict of interest or an appearance of conflict of interest concerning our agenda today? Hearing none, so there are no conflicts from the board. Thank you. Item D, I'll entertain a motion to approve the agenda. Mayor Pro Tem, and a second by Alderman Davis. Any further discussion? All in favor? Any opposed? Motion carried unanimously. Thank you. Before we get into the agenda and before I call on our city manager, I would just like to give just very brief remarks. I want to thank our consultants for being here today. This is First Try-In Financial Advisors. And they're going to discuss with us today the water and sewer expansion. I want to thank the city staff for working with them and with the advisors and arranging for this workshop. The goal is to develop a plan of finance for the proposed project and also assist city leadership in determining the necessary rate increases required to fund the proposed project. And it has to be a collaborative effort, city, county, state, federal, and funding from grants, loans. It really has to be a collaborative process. And this is a series of the series of infrastructure projects that we're working on, whether it's electricity, our roads, our fire, hospitals, schools, water and sewer. I'm sure y'all read the excellent PowerPoint presentation, and I'm looking forward to hearing it in more detail. And I would like to close with a quote from your company, gentlemen, and it says, "Our mission is to give our clients peace of mind by delivering expert advice, innovative planning strategies, and tailored financial solutions." So I thank you for that. Thank you for being here, and I call on City Manager Bonnie Theron. So thank you.
Good morning, everyone. Can you hear me? Is it working? Good. Appreciate everybody being here. This is meeting two of three this week, so you guys have taken a lot of time. I appreciate it. I really hope, I'm very thankful that Steve is here, our county manager, so he can help us with assumptions to make sure we're on the right target with everything. I think most people kind of realize how we got here. It's been a long history of where are you going to put it, where are you going to go with the county, where are you not. And meanwhile, the infrastructure really had not been touched. So it's a combination of needing to expand the county system so that we can then go into the system over in Bolivia, as well as infrastructure that is so old that has to get fixed. Between everything, it's just all come together at a peak, and we've got to fix everything and get this done ASAP. When the county, Mr. Stone had asked me that he really needed to have thoughts from the board as to where they want to go with their, how much debt they want to take on, I thought to myself, oh my God, how are we going to do all this? There's just so many things. And I know I have worked previously with financial advisors who are just, do a stupendous job. That is all they work on, is debt and how to put it together. Well, it took me forever to find a financial advisor. So I must tell you, to work with these gentlemen, we had our first meeting February 14th. And they had to absorb so much information in such a short window to have this presentation for you today. And you're going to be able to go through this. You're going to be able to throw out assumptions. You're going to be able to throw out, gee, could you look at 5% increase, whatever. And their model is so good, they're going to be able to instantly give you what those numbers are going to look like. So I am thrilled that they are working with Southport. They've been awesome to do. I just wanted to also mention what you're going to see today is a very, very conservative outlook. There are lots of things we could have said or what ifs or that. I don't like doing that. I know Melanie doesn't like doing that. I'd rather go on the conservative side, and then if we apply for grants in May and we get 20 million, hallelujah, that's great. But if we don't, as we just did not with ARPA funding, I'd rather go conservative. Let's worst case scenarios, and then we can go from there. As was mentioned, I have not worked with these guys for long, so I mean I know they would probably like more time to come up with other scenarios, but I know Steve Stone and the county would like to have an answer from you as soon as possible. Right now I do have it on your agenda for March to kind of give them some answers. So with that, I'm going to introduce Walter Goldsmith, who's the president and COO of the company, First Tryon Advisors, and then David Cheatwood, who's our managing director. And I think, David, you're going to be up here, right? Okay. And it's on now. But if you need to shut it, just hit the button.
Thank you, Bonnie. Good morning, everybody. Thanks very much for having us here this morning. Again, my name is David Cheatwood, my colleague Walter Goldsmith. Again, the main topic this morning is to talk about the funding and financial impact for the new, for the expansion of the sewer treatment plant of the counties. And so wanted to start off, though, with a really quick introduction of our firm and who we are, what we do. Promise won't spend a lot of time on that, and then we'll quickly get to the matter at hand. We are, and I know you have some information in your packets, we'll have it up here on the screen as well, but our firm, First Tryon Advisors, we're based in Charlotte, North Carolina. That's where Walter and I are based as well. We are a full-service financial advisory firm. We work with cities, counties, towns, utility systems, public, private colleges, universities, hospitals, healthcare systems across the Carolinas, and Georgia is our main footprint. Walter and I primarily work with the local governments and utility systems in the Carolinas. As a financial advisory firm, we are not a lender, we're not a bank, we're not an underwriter. We're purely a financial advisor, which means that we sit on your side of the table. We have a fiduciary duty to act in your best interest. We're really here to help you analyze your options, provide you with all of the information so y'all can make a fully informed decision on the best way to go forward. So again, that's our role. On the advisory side, we've given you a little bit of an overview of our experience, the other clients we work with across the state. Again, you'll see it's really heavy on the cities and counties and utility system side, but we also do a lot of work in the higher education sector as well. I would say with that North Carolina experience comes really good knowledge of the local government commission. I'm sure y'all are aware of that group. They're the ones that have to approve all of your bond issues, and so we work constantly with them and their staff, and so know what their policies and procedures are. And so the things that we'll talk about in terms of the financing and potential next steps, that's all with an eye on what they are ultimately going to need to see from you all and the different steps you'll need to take. Also know all the different bond counsel firms. Again, if you go down a path of a revenue bond issue, you'll need to have a bond counsel that helps you with the legal side of that as well. So really familiar with all of those folks. Giving you a little bit of bio on myself and Walter. That's for your reading later if you wanted to. In terms of our role as a financial advisor, again, we sit on your side of the table. We do a lot of what we're really talking about today, which is the pre-planning work, where we are helping you with what is my debt capacity, debt affordability, what is the financial impact if I fund these different projects out there? Do I fund them with debt, with cash, with other available sources of funds? So we do a lot on this pre-planning or capital planning side. Oftentimes that leads to the need to issue debt, so we transition to this transactional service where if it comes time to issue debt, we take you through that process, take you through the local government commission approval, help you decide where to issue that debt. Is that debt in the public market where it requires an offering document and requires you to get credit ratings? Can you go and place that debt directly with the bank? So help you determine the market and just take you through that full process. And then we have this kind of circle back to the pre-planning. We know once you close on a debt issue, that's not the end of it. You circle back to that pre-planning aspect, get ready for what's on the horizon coming down the road. And that's what, again, this pre-planning, long-term planning, we don't want to just say, hey, you've got one need, how do we fund this need with blinders on, not thinking about what the other needs of the city or the system may be. We want to have everything, at least the plan for everything initially, so that we can take those other factors into account. So that's our brief summary here. Again, want to dive into the matter at hand, which is the financial impact of funding an expansion to the county's sewer treatment plant. And so, as Bonnie mentioned, we were just hired by the city 2 weeks ago, so we have jumped in here with both feet. Bonnie and Dory and Melanie have been great about getting us information. When we get to, or ask the question about what's our impact of funding this project, or how do we fund this project, we go to that planning, that modeling stage. We love models. We love the interactive dynamic models, because in a setting like this, we can come in, if we just came in with a static answer, static scenario, and you all gave us the what if questions, we would say, good questions, let us go back to our office, we'll run that, we'll come back in 2 weeks and we'll show you that version. So we've developed a model along the way to help us, change those different variables and assumptions live, so we can address the what if scenarios here. And that really helps, whether it's build consensus, kind of move the project along on a timely fashion. And I know time is of the essence with y'all, with this project in particular. But we were tasked with, what is the plan of funding this project? How do we fund it? What's the impact of funding it? And when we talk about the impact with a utility system, we're talking about rate impact. I mean, with the size of the project here, y'all will need additional revenue to fund this project. That additional revenue is going to come in the form of rate increases. And so at the end of it, the punchline is, well, what's the impact on the rates to my customers there? And so we'll get to that here in a few slides. So if you go back 1 second, Walter, on the when we get into the modeling front, what we're focused on, as I mentioned, is not just the project, but we want to take a full view of your system. So we're looking at your existing revenue streams, primarily consisting of the user revenues, your water and sewer revenues coming in. Y'all do have some other tap fees or availability fees coming in. And then also, what are your operating expenses? We don't want to forget about those. If those are increasing by a certain amount, we want to take those into account. I mean, that's a lot of times the first step, or not a lot of times, the first step is you've got to pay your operating expenses, and then we move on to debt and other capital needs. And so we've taken a dive into your operating revenues and expenses, and then also, what else do you have on the horizon, near term and long term, in terms of other capital needs? We do have a few other specific things turned on in the model that we'll mention, and then we really have a placeholder in there for funding additional capital needs. We know with the utility system, it's in constant need of update and repair there, and so we've got a placeholder to that we'll talk about. We've loaded up your existing debt that you have on your utility system. You don't have a lot of it right now, but you do have a couple state revolving fund loans, and so we've loaded that up so we can see when that pays off. That obviously helps when you load in new debt. It can mitigate the impact there. And so we'll go through the model. We'll talk about the initial scenario we've run, and then we'll kind of open it up for questions, and we can run additional scenarios. The one caveat I'll give here, I think Bonnie mentioned this. This is a preliminary analysis. We've jumped in again over the last 2 weeks. Feel good about what you'll see here, but like with any model, any long-term projections, they're only as good as the assumptions that we have in there. So I'll highlight some of the assumptions we have on the revenues, things like customer growth, rate growth, and then on the expense side, as well as those other capital needs and our debt assumptions, what interest rates are we assuming, things like that. So a lot of variables in play here, and so as you move those around, the end result will change, but we'll highlight what we have currently turned on here. So specific to this project, the expansion of the county's sewer treatment plant, the total estimated cost we've been provided is approximately $55 million. It's our understanding y'all have right now $30 million that you've gotten from the state in the form of an SRF loan that you can access. You've been awarded that. That $30 million would be repaid over a 20-year period, and you've got a great interest rate of 1.3%. The SRF loans over the last year or two have been really fantastic, well below where you could get from a bank or in the public markets. The 1.3% is an excellent rate. Be great if that matched the amount you needed. This would be a really short conversation. But as you all know, the estimated amount is looking a good bit higher than that. So we've got this gap of $25 million that needs to be filled. With the utility system, the typical path to do that is with a revenue bond issue. Unlike if you had a new fire station need or police station, city hall, you could look at a general obligation bond where you're pledging your taxing power. You could look at an installment financing where you're not pledging any revenue, you're pledging the asset you're financing, but you're paying it from property tax revenue, for instance. This third leg is a revenue bond, and those are the three most typical financing structures in North Carolina. With a revenue bond, what you're doing, you're not pledging your taxing power, you're not pledging the asset you're financing, you are pledging your revenues in this case, of the utility system. So we'll talk about net revenues. We'll talk about that when we talk about coverage of the new debt. But in terms of the pledge, you are pledging the net revenues of the system, which are total revenues generated less operating expenses. And so as I mentioned earlier, you've got to cover your operating expenses. What we're looking at is how much is that generating in terms of net revenues. That's what's available to pay new debt service, to pay for capital projects on a pay-as-you-go basis as well. So I'll keep going back to that net revenue. But that's your pledge under a revenue bond issue. And so the typical terms, the local government commission typically likes you to amortize revenue bonds no longer than 25 years. I mentioned that SRF loan at 20 years. And so with that additional $25 million, you could go out 25 years on that, maybe be able to go out 30 years. Statutorily, you're able to go out 30 years. The local government commission sometimes lets the larger kind of systems that have really sizable debt go out 30 years. And so I don't want to say 30 years is not possible. We've taken a little bit more conservative view and said 25 years. And the typical repayment structure is what is called level debt service, or mortgage style debt service, where you're paying the same amount each and every year, principal plus interest. It's a level payment structure, as opposed to if you issued a general obligation bond, the local government commission would want you to issue level principal repayment. So your first overall payment's the highest, and then it goes down over time. What we're talking about here is 25 years level debt service payments. You'll see this last assumption, interest rate of 5%. As I'm sure you've all been following, rates have been increasing pretty drastically over the last year and a couple months or so, since January of 2022. And so with that, all rates, short-term and long-term rates, are going up. It makes that 1.3% look even better. If you were to issue that debt today, you'd probably be around 4.25 to maybe 4.5%. So we've got a little bit of cushion in there. Rates have gone up the last few weeks to probably take you north of that 4% range. But we've assumed a 5% interest rate for that $25 million. What you'll see on the right-hand chart is just with this new debt, so not thinking about any other debt, not thinking about the relatively small amount of existing debt you have out there, you'll see when you stack those two together, it's about $3.5 million per year. After 20 years, you'll see how that rolls off. That's with the SRF loan maturing. But you've got to generate about $3.5 million excuse me, $1 million just to cover the debt on this side. And so a couple other finer points here. You'll see when that comes on, the SRF loan, you'll see it doesn't pick up until 2026. Well, typically with SRF loans, once you get those, you don't start repaying them until the project's complete. And so if you have an approximately 2-year time frame for construction, fast forward, it's complete in 2025, you would start repaying it in 2026 typically. The revenue bond, if you issued that, for instance, in fiscal 2024, that would start repaying the following year in fiscal 25. So our just kind of base case for the debt assumptions for the sewer expansion are here. That's what the $55 million would look like. If you go to the next tab, some of the other assumptions, I talked about assumptions being key in all of this here. Let's talk about the revenue side for a second. We've got different assumptions on customer growth, on consumption, on obviously rate growth as well, both base rate and volumetric. You've got these other revenues, the tap fees, the service charges, and also availability fees. So taking those in turn, customer growth rates, we've assumed that for water and sewer, for water, you've got a 1.5% growth rate per year for the next 5 years. And I'm going to focus primarily on the next 5 years, so through fiscal year 2028. The model goes out, basically to infinity, but I think really for the next 5 years is what we're focused on. We can show you longer term projections, but 1.5% water customer growth rate for the next 5 years. Sewer, I think, Walter, we got 1% in there, either 1 or 1.5% on the sewer side. So some customer growth, not dramatic. After 2028, we tail that customer, we pull that back to 0.5% growth after 2028. So trying to be more conservative there. On the ancillary fees that are generated, let me go back, consumption. So what we have in here for consumption is 2 different variables that come into play. One is just overall consumption. We are assuming that goes down actually by 1% per year. In total, consumption would go up because your customer growth is going up, but basically each customer is using a little bit less per year, whether that's from an efficiency standpoint, you're using more efficient toilets and everything else that uses water or sewer. We see that, industry-wide there is definitely some of that in play there, but we've got in there 1% decline in consumption per year. And then there's this other variable called elasticity that basically is as you increase rates, as rates are higher, as it's more expensive to use water and sewer, users may use a little bit less because of that. And so we have a little variable in there for elasticity that basically says for every dollar you increase rates, you'll realize about 98 cents of that. So we've got a 2% elasticity factor built in there. So that's on the consumption side. So basically consumption going down a little bit per customer, your customer growth is growing. So total consumption is still growing, but each individual one is using a little bit less.
David, is it fair to say on the customer growth, which is the number of new customers coming in each year, some communities that we work with are kind of anti-growth, if you will, and so they know as a board that they're trying to slow down new apartment complexes and new subdivisions, and so they say, yeah, let's assume that the number of new customers only grows at 1.5%. We've got other communities, surrounding Charlotte as an example, where they say, we are seeing a ton of development, we like it, our arms are open, we tell all developers to come, and so let's assume 3% growth in the number of customers. But that is one variable that, and some clients who say it's beyond our control. We take all the growth that came, but we're just a part of the Carolinas that are rural, and we're not growing, and so let's assume flat growth. But that is a variable that you said, ramp it up to 3%, then we're adding 3% new customers, which means that's less of a rate increase that we have to understand.
And the flip side to that is if you show this more rapid customer growth, well, with that's going to come additional needs. So if we show that for 5 years consecutively, are you going to need an additional expansion to the sewer treatment plant to cover all that? So it is really interesting when you get into the model, you tinker with one variable and you think about the follow-through effects on the other ones as well. But the customer growth is a big one that's in there. Availability fees, also known as the system development fees, we've just kept those flat from your fiscal, from your current budgeted levels, which is about 780,000. Those are tough to project, and we'll tell you on the front end, we are not, that's driven, I think there's a specific formula and process you have to go through for all that. We don't do that. We don't do the system development fees formulas and how you get to that. Other consultants are doing that, or can do that, and those can only be used for certain things. So we've just flatlined that growth or flatlined that number at 780,000 per year. The 780,000 is a hard dollar amount that we're just flatlining the dollar amount there going forward. Not, it's not tied to the 1%. I guess it could be if your customers are growing and they've got to pay that to get in.
Yeah, I mean, I don't know how you flatlined it if your assumption for growth is going to make the impact of that fee different.
Right.
So right now we have, I think, like 600 units that are in some phase of being processed right now, not counting Indigo project.
Right.
Well, that's at 500 units, that's about $9 million.
Yeah.
Now, they're not all going to be sold tomorrow, but the current rate of buying is such that we'll have to tinker with that a little bit.
Yeah,
Okay?
and that's within the model. We can certainly do
'Cause
that.
We could
can-
literally, by the end of this year, we could have 11 to 1,200 units somewhere in the building phase. So that's more than 1% of our city.
Sure, and that,
Okay.
that's system development. I mean, those can be big numbers. I think in fiscal '22, Melanie, y'all had over $1 million in the system development fees. I know you budgeted less, got it more, so those can be big numbers. It just honestly takes a deeper dive into what those are, the number of units coming on, when those will come on and pay those fees, and that's again something that we don't typically do on the system
When you have
development fee side.
these loan type, this type of loan, do you get a benefit for paying it off early?
You have the option to pay it off early. Typically, 10 years is the standard period where you can't pay it off early, and then after 10 years you can with no penalty. And so if you built up, cash with system development fees coming in, then, and you wanted to pay off all or a portion of the debt early, you could do that.
But it's a 10-year wait.
10 years, the standard. There's ways to shorten that, but 10 years the standard there. But that's, definitely something that can swing the model. I would say when we look at projections, whether it be a lender or a rating agency, they will, unless those projects are in process and you say, hey, we're going to have these soon, they tend to discount the big growth in terms of the availability fees. They are focusing more on the recurring user fee revenue that's coming in. It's part of the system. The revenues count. It counts for everything, but they tend to focus more on that recurring revenue, that user revenue, versus the more one-time revenue that comes in. Again, it's all still money coming into the system, can be used for that, but they try to say, all right, if a recession hit, all those units stopped, construction didn't come online, and you've already issued the debt, can you repay it? And so they look at it both ways, with and without.
In theory, if you were selling a lot more homes than you had projected, and you had this extra money for the $18,000 per house, and whatever the numbers are for commercial, you could adjust the rate that you charge the customer, because if you had a profit, it's because of the first 10 years you can't get out of the loan. You could adjust, theoretically, you could adjust, I'm asking a question, you could adjust the rate down,
Your user rate?
user
Yeah.
rate, because you could supplement that with the extra money that you had.
Yes, you could. Now, whether you would want to or not, that's obviously your decision. I think, that a lot of folks will not want to do that, because then if the next year doesn't come in and then they've got to go right back up, you've got more of the kind of yo-yo effect there. But
Well, if you're paying $100 more per unit of sewage,
yeah. So to
You
answer,
might wanna do
yes,
something.
you could do that. I mean, that's a board decision. Y'all could do that. We don't typically see that, but
The other thing you'll hear that referred to sometimes is living off of growth, where you're taking the new customers that are coming in, you're taking those availability fees to subsidize rates. Sorry, I'm not talking into it. To subsidize rates. And so particularly if you've got an older system, the thought is as you're bringing in those new customers that are paying those availability fees, you might have deferred maintenance that you need to be doing or setting aside that money for new expansions that are going to come in. And so we've had situations where clients have used those to subsidize rates, keep rates low, and then they get to the point of needing to expand, and they've got a little bit of a problem. So it's or not setting aside enough for retirement, if you will. You know you're going to have cost at some point in the future.
So those are our high-level revenue assumptions that are currently in the model. Again, these are starting points. On the expense side of things, we are looking at your basic operating expenses growing at 2.5% per year, and that's over your fiscal 2023 budgeted numbers there. So growing 2.5% year for pretty much every expense line item. For sewer repairs, this is more of the kind of general repair of the system. These are not the larger capital projects. This is, think if you're doing a house, these are the roof replacements, the HVAC, those types of repairs to keep your system going. We have those in there at $600,000 per year for the next, really going out every year in the future. You've budgeted about $676,000 in the current fiscal year 2023, so we want to keep a placeholder in there. Some of those are more of the surprise types, the line breaks that happen here and there that you've got to repair, so we wanted to keep a placeholder in the system for that. On the contract services, that's from the county related to the sewer, we've assumed that that would go down once the expansion is open. And so y'all paid $1.4 million, I think is your current budget number. We've assumed that's still in place for the next couple of years. We've assumed for now the expansion is complete by the end of fiscal 2025, at which case, beginning in fiscal 26, that contract service line item related to your sewer payments would go down approximately in half to $700,000 per year. Again, that's a detail, kind of working with the county to figure that out. We can fine tune that as we go. In addition, we talked about those kind of general repairs that you have. You're also going to have larger repairs, the bigger ticket items. We want to account for that. We do have a couple other borrowings turned on, one other borrowing turned on that I'll talk about here in just a second, but you're going to have other needs of the system. So we have included $1 million per year of other capital needs that are going to arise. It may not be $1 million per year, maybe 500 one year, $1.5 million, but we wanted to have a placeholder in there. Basically, think of depreciation. You'll have depreciation. That's a non-cash item, but it basically means your system's getting older. You need to put money back into your system. Your depreciation in the current year, I think, was budgeted at $850,000, and so you also had a capital reserve of $250,000 in your current budget. That's essentially what that $1 million makes up for, replacing the depreciation expense and then capital reserve. So that $1 million may build up, but eventually, you would use that. You would have cash on hand for pay-as-you-go capital needs. Additional debt. So the main topic is the $55 million in debt, but it's our understanding you also have another $10.5 million project for sewer lines. Is it sewer lines or water lines? Sewer lines. You've got a grant for $4.5 million, and then you have a USDA loan for $6 million. So we've got that $6 million turned on in the model. So when we look at the outputs here, that is baked in. That's baked into the numbers, and so that is over a 40-year period. USDA allows you to amortize it over a longer period of time. You may ask, well, how can we do 40 years? And I just mentioned 25 or 30 years earlier. Technically, the local government commission doesn't have to approve USDA loans, so y'all can go longer than the 25 or 30 years. And so you've got the 40-year, in this case, at a 2.625% interest rate is what you've been provided. So that is turned on in the model. The main outputs that we're focused on, there's two main financial outputs that we focus on: the LGC, rating agencies, banks, bond investors. The first one is called debt service coverage. And so going back to my example or my note on net revenues, that is operating revenues less operating expenses, that gives you net revenues. Debt service coverage is taking that net revenues and dividing it by your annual debt service or your annual principal and interest payments. That is a key number that everybody looks at. For starters, just common sense, that needs to be over 1 times, because you have to have enough revenues, you have to have enough net revenues to pay your debt. However, in revenue bond situations, they demand a higher level of coverage. Typically for revenue bonds, and I'm going to make a distinction, hopefully I don't go too down a rabbit hole here, but you have senior lien revenue bonds and then kind of other water and sewer debt. For senior lien revenue bonds, where they have the first right at those net revenues, those bondholders have the first right to those net revenues, you need to have a minimum of 1.2 times debt service coverage. That'll be in the form actually of what's called a rate covenant. It's going to say the board agrees to set the rates necessary so that your debt service coverage is at least 1.2 times. That is a bare minimum. The target for senior lien coverage should be higher. That's one of the main credit drivers. They will look at that as how healthy is the system, how creditworthy is the system. So the higher you can go above 1.2 times, the better in the eyes of the lenders and investors. And so a good rule of thumb, good target for that is 1.4 times coverage on your senior lien revenue bonds. I keep mentioning senior lien because you can have subordinate lien, which is the second in line for those net revenues, and in North Carolina, state revolving fund loans are technically subordinate lien. So if we, taking your $55 million, for example, your $25 million revenue bond would be senior lien, and your $30 million SRF loan would be subordinate lien. So when we talk about coverage, you may hear me reference the senior lien coverage, or really total coverage. That is looking at all of your outstanding debt, senior and subordinate lien. For total coverage, your bare minimum needs to be 1 times. Again, you have to have enough revenues to cover all of your outstanding debt. And a good target, good level of cushion for total coverage is 1.2 times. So senior lien, 1.2 bare minimum, 1.4 is a good coverage target. Total coverage, one times is the bare minimum, 1.2 is a good target. Anywhere in between there works as well. So within the model, what we've started with is to make sure our total coverage is close to 1.2 times or higher. That 0.2 that is generated each year, that cushion, that drops to your bottom line in the form of cash, which helps you pay the $1 million in capital improvements per year or other things that pop up. So if you were running everything at exactly a 1 times coverage, you wouldn't be building any cash each year in order to fund those capital, that $1 million of capital projects, which all happens below that line, because the $1 million of capital is not an operating expense. That's below the line. So you got to have enough cash to cover that. Speaking of cash, the other key financial ratio we focus on is your cash. We look at it in terms of days cash on hand. How much unrestricted cash do you have? And essentially, how long could you run your system without any additional revenues coming in? So the formula there is looking at your unrestricted cash and dividing that by your annual operating expenses. That tells us how many days you can operate the system without any additional revenues. The good bare minimum target, I think, for y'all would be 180 days or 6 months approximately. A good target, we've talked about minimums and targets. A good target may be closer to a year's worth of cash on hand, just for the surprise projects that may pop up. Again, y'all are in a coastal area. Obviously, having a little bit more cash is a good idea if you have a weather event and you need to make improvements to your system quickly. So typically for coastal entities, having a little bit higher cash is advisable. So those are the 2 things we'll focus on here in just a second. So let's get into some of the numbers here. And again, this is with our first pass at this with some of those high-level assumptions. What we are looking at, you'll see historically, the top of this chart is your historical revenues. So you go back 5 years, y'all were generating about $3.5 million of total revenues. And then, and I will say, what's in the non-operating revenues, those are your availability fees primarily. 4.6 million in 2019, 5.3 in 2020, 5.7 in 2021, and then 6.9 in 2022. So you'll see on the top line, operating revenues, that's primarily your water and sewer charges there. That's grown, several $100,000 per year, tied to customer growth and rate increases in the past. And then the non-operating revenues are your availability fees. You'll see that $1.4 million number I mentioned that you had last year. Those, a lot of activity in this area, a lot of development, new fees coming in. So that's been a big driver of your growth, is that your revenue growth are those availability fees. In terms of projections for revenues, and so when we're trying to hit those desired debt service coverage and cash targets that I just mentioned, and we've loaded up the $55 million in debt, we've loaded up the $6 million of the USDA loan, and the $1 million of annual pay-go capital, we need to generate revenue that's going to grow from, your current budget in fiscal 23, similar to where you ended up in 2022. I know y'all had rate increases that came into effect this year, so that'll increase your user revenues. You've got a conservative figure, I think, on your availability fees for your current year budget at that $781,000. But you'll see if you fast forward 5 years over this projection period that we're focused on primarily, you're looking at, sorry, I got a glare on that side. Walter, what's my number out in 2028? 9.2 million. So you've got to grow from where you were about $7 million in fiscal 22. We've got to grow that over $2 million, $2.2 million over the next 5 years in order to help you pay for this new debt.
And if you're looking at that in your printed packet, I think we cut it off in 2027. What we have on the screen, we felt like we could add one more year and make it fit, so we added 2028. So I just wanted to track that. Otherwise, the numbers are the same.
So how did we get there, or how do you get there in terms of that increase in revenue? And so that's, again, customer growth, consumption growth, and rate growth. Those are the three variables in play here. So what I talked about, the customer and consumption growth earlier. What we've done on the rate side initially is to assume, and this is where you've got some variability too, or different things to look at, we've assumed both water and sewer rates go up uniformly 10% in fiscal 24 and 25 and 26. That is on your base rate and your volumetric rate. So 10% across the board increases, water and sewer, for the next 3 fiscal years. Dial that back to 3% per year in the 4th and 5th year of our projection period, so fiscal year 2027 and fiscal year 2028. And then we've just got an annual 1% increase thereafter. To quickly touch on the thereafter component, if we have your operating expenses growing by 2.5% per year, if your customer growth is only growing by 1.5%, then there's a mismatch there. So we've got to assume some sort of growth just to kind of break even. But that's why we've got some sort of 1% growth going after that. But for this projection period, this 5 years, 10% for the next 3 years, 3% thereafter. That is on all of your customer classes, residential, commercial, that's inside, that's outside, water and sewer, base and volumetric. Wanted to start pretty high level. Let's just across the board, let's do this. You can dive into kind of different ways to still achieve that. At the end of the day, what we're looking at is we need that revenue. We need the total revenue number to be generated. How y'all ultimately want to get there in terms of the rate increases and which customer classes, water versus sewer, that's y'all's decision. You can think through and decide on, but this is our starting point. So with those rate increases, you'll again go back to those total revenues go up to $9.2 million. So that top part is the same. Your total expenses, you'll see how those operating expenses grow approximately 2.5% per year, with the exception of, you will see in operating expense from 25 to 26 a decline That is tied to the expansion of the plant is operational now, and your payments to the county go down with those contract services. That's our understanding of how that works there. So that's the dip, and then you'll see it start to go back up. You'll see the debt service coming online, starting out in $2 million. That's tied to the revenue bond piece of it, the $25 million, and then it steps up another $1.7 million, which is tied to the state revolving fund loan. So that additional $3.7 million, I will say the USDA loan's built in there as well. So at the end of the day, what we're focused on there is the bottom, those net revenues or net earnings. That is after paying your, actually that's not net revenues, that's just your net earnings. That's after paying your revenues, your expenses, and your debt service. You are dropping to the bottom line anywhere from $500,000 to $1 million per year. That allows you to fund that $1 million per year of capital improvements. In the years where you're getting in less than that, that's okay because you've built up cash in prior years. We're just focused on total cash, not always on an annual basis. It doesn't have to be exact there. In terms of the outputs on the coverage and cash ratios, the one I primarily want to focus on, well, I'll start on the top, the senior lien coverage. So that is just the $25 million revenue bond as well as the $6 million USDA loan. I think that would be considered senior lien debt. You'll see that that coverage ratio in the middle, sorry, I'm starting in the middle, is over 2 times. I mentioned 1.2 minimum, 1.4 desired target. You're well in excess of that, so you're good there. The top line is the total coverage, so that is adding in the $30 million of SRF loans as well. You'll see where that is. We're in that kind of once the full debt is on, and by fiscal 2026, 1.15, then 1.2, 1.28. So we're in that approximately 1.2 range. We've got a little bit of cushion there. That's what's helping drop some of that cash to the bottom line. So check mark on senior coverage, check mark on total debt service coverage, and your days cash on hand, you'll see it's actually, exceeding that year target that I was talking about. You're about 500 days cash on hand, so a little bit more than a year. We've got the dollar amount in there as well. That's something, again, with that $1 million, it's an estimate there. You can, that's a strong cash position. You could look at using more cash, or if you had other projects pop up, that would certainly cover it. You'd have a good cushion there. So with this first pass of the assumptions on all of those variables, this would work from a financial standpoint. What does that mean in terms of those rate increases to customer bill, which I know is the punchline, as I mentioned at the start of this, that y'all are interested in. There are different, when we look at customer bill, typically we're looking at an average residential bill. What we've run here is on assuming your usage is 4,000 gallons per month. As I understand it, y'all are a little bit less than that. I think y'all are closer to maybe 3,000 gallons per month as the average residential user. If the LGC and they track peers, they would actually use something higher. I think the LGC maybe uses a 5,000 gallon per month. Some of the rating agencies, when they're looking at trying to compare you all versus other entities across the state or country, they actually look at 6,000 gallons per month. So there's different ways to look at this. For now, we've used 4,000 gallons per month just to look at what that bill would be. You can see where you were in 2022 at $137 approximately, based on the rate increases you adopted for this fiscal year, right around $150 for 4,000 gallons. And then with these rate increases baked in there, fast forward 5 years, it'd be at $212 in total. So, an increase of another, $60 or so over the next 5-year period based on all these assumptions. So, we've got the model we can pull up. Happy to answer any questions on this initial analysis. I'll finish with the caveat that I started with, that this is our first look at this. These are based on these assumptions we have in there, all of which we can change and look at and dive deeper into, but this is our first look at this. I know a lot of info, so.
I don't think we have a copy of that. Can we enlarge that, or what, to
Sure,
read off each year's numbers or something?
Was that, yeah, that we may have added that in after, I'm sorry. No, you're in the right one. We have some just screenshots of the model in the back, yeah, right? Go back up one.
You were at $137 a month for a customer who's using 4,000 gallons. And then in 2023, the current fiscal year, that was at $150 a month. And then, as David said, going all the way out to 2028, that would be at $212.
So as a reminder, the 24, 25, and 26, those are the 10% increases per year. So you'll see those bigger jumps in terms of the total dollar, and then we dial it back to 3% per year, so relatively smaller jumps in fiscal 27, 28. This is to pay the total of $55 million plus the $6 million USDA loan that you have out there as well, or will have out there. No, this is putting your 2% aside, like starting anew, from where you are in 2023 going forward, not in addition to anything else you've discussed previously.
Plus, it would include upgrades to the infrastructure, because you still got to put money in there for that. So that would include keeping up the system as it is.
That $1 million a year you're talking about, Bonnie? Yeah.
Good morning. Thank y'all. Just real quick, and this is probably a question more for the city manager. We have the $30 million loan at the 1.3 or interest rate. Is that a capped loan? I know that we increased it previously, reapplied, and were able to increase it previously. And I didn't know if that was something that we could increase that loan as opposed to going to a bond conversation.
I think we're maxed out, Melanie. Yep, I think so.
That is correct, Bonnie. They bumped it up just in the last month. DEQ told us that they would add a little over $1 million to it, and that loan is capped out at the $30 million. But we could reapply for a state revolving fund in May.
There's
Which we're planning on.
two application cycles per year, one in the spring, one in the fall. Then you hear on that, 3-4 months later. Y'all also applied for grant funding as well, so the free money, which is the best kind, did not get awarded any
Correct.
of the free money in the most
Plus, I
recent-
asked in that list that I sent to Representative Miller and the senator for monies there. But again, at this point, you can't assume any of it.
And,
I'm sorry.
No.
Have you talked with Emily Miller as far as the likelihood of us being able to increase? Because I know she's our grant writer that we've worked with.
Go ahead. I mean, we've had discussions, many with her.
Right, so you're talking about increasing the $30 million loan that we have. No, DEQ set that's maxed out. We cannot increase that loan anymore.
Even if we reapply,
We can reapply, and it'll be a new loan,
Right. At a different
at a
interest rate.
different interest rate.
Which
Right.
would still likely it'd still be better than you'd get on the revenue bond. So that's, in our general view, free money's best, SRF loan is next best, and then you go to the revenue bond side. The predicament I think y'all will find yourselves in, that a lot of others do as well, is do you keep going down the path of trying to get free money or additional SRF funding or SRF loans, which take time, and therefore you're putting this project off, or at some point do you say, we can't wait anymore, we just need to do it, we know it's a higher cost, but we've got to move forward. And again, that's up to each board their own for that decision, but that's a pretty common predicament that folks, especially these days, are finding themselves in. They know there's federal money out there or state money out there, but they got to go through the process to get it. They can go and access the other market much sooner. Trade-off to that.
And that's where we're at, because I know, Mr. Stone and the county commission wants to rebid this thing, but they got to know a commitment.
On the USDA loan, or the $30 million loan, not the USDA, but can we keep that existing loan in place and apply for a second loan? Is that, I mean, it wouldn't eliminate the current one and have one whole new one, we'd just get a separate one, right? So we could keep the interest rate for the 30 million that we've got.
That's correct.
We keep the 30 and apply for a second one. And if the second one is everything we want, we basically just don't activate the 30? Is that the question? No, so we'd have two loans, okay.
If you get additional there, you don't activate the 25 million revenue bond. That would be the replacement, yeah.
If we assume $50 million in debt, in a parallel universe, we're trying to figure out the feasibility of this county taking over.
Yeah, good question.
Does the county absorb the debt? Is that how that works? And then, when if the county absorbs the debt, is the debt spread out over the entire county, or is the debt, the rates for Southport would then be higher than everybody else because they absorb the debt?
Really, it's,
Yeah, give us an answer we want.
If there were to be a true merger of the systems, the debt assumption would probably occur, and it would just become part of the county's debt, or the county might actually refinance it because we probably can get money cheaper than Southport can because of the size of our utility.
yeah, and that's, to echo that point, because we're having this conversation with a different client of ours, no doubt the county's cost of money would be lower than yours. That 10-year no prepayment provision I mentioned earlier, if it comes to that situation and you wanted to refinance it, that may prevent you from accessing that lower cost from the county until you get to that point in time. Again, I think a lot of this wades into how the county's main water and sewer master trust indenture reads and the things that they can do, what their bond counsel would say. If you set up and do a revenue bond, kind of what your master document would say as well. But those are kind of two observations. Just, again, their cost of funding would be a little bit lower, and then two, potentially not being able to refinance it for some period of time due to that no prepayment provision.
Well, that was my question, is that would the county be stuck with the 10-year before they could refinance the loan? Like we
Yeah.
couldn't pay it off early, or that would go along to them? So let's assume in year 6, they took it over. Would they have 4 years before they could recapitalize the money?
Yes, I mean, that's the standard provision. Again, if we're doing this and we think that's a possibility, we can try to shorten that time period and maybe do a 7-year. You pay a little bit more for it if you're going shorter than 10, but there are ways to shorten it a little bit, but there's not I don't see a scenario where you're going to just get it in prepayment in year 2 or 3. So that's something to kind of keep in mind, is that I'll say 7 to 10 year no prepayment period. So if they assumed it, they'd have to live with it for a certain period of time.
Well, when they assume that debt, they own the thing that we're financing.
Mm-hmm.
It sits with them. They're assuming the debt for capacity that they would have
Right.
fully control over. So it's
Right.
not like a debt that they never have any new revenue coming in.
Right, right.
Because we get the revenue.
Right, I
for
think,
part of that revenue.
I think the benefit would just be potentially lower.
Okay.
Something. We got the a request from Bonnie yesterday to try to think about what kind of percentage we think that the city could tolerate. And as I studied all this, I also looked at the North Carolina Department of Health and Human Services guideline, according to the Federal Register, of poverty level. A family of four, this is for fiscal years 2020 through 22, so end of June this past year. A family of four is at the poverty line at 52,400 annual income. And the poverty line, of course, is exactly what it's going to take for you to pay all your bills, all your living expenses, and you won't have anything left over. And that's certainly going to rise in this year. So, and I think that we should keep this in mind when we're thinking about what we pay our city staff. That in mind, this brings me to the last sentence in your conclusions and next steps, that you would like to work with us to implement a more specific rate increase plan, which may vary among customer tiers. We've got basically two tiers, right? 1,000 gallons, and then
Increases is like 3 tiers.
oh, 3 tiers worth. But if we could take a better look at that, or a different look, to try to ease this impact. But thinking back to it, a family of four uses a lot. Let's say that most of those are kids. Let's say 2 parents and 2 kids. That's a lot of laundry, that's a lot of toilet flushes, showers, and so on. So where I'm going with this is, what kind of things are you, do you have in mind as possibilities for customer tiers that would ease this burden, assuming that we're going to have to go with a 10% increase? But that, in other words, to keep that 10% rate increase from being just flat across the board.
Sure, and that's where, within the model, we've built out your rate structure, which you have a base rate, and that base rate includes 1,000 gallons of usage, and then you have a volumetric rate, which for water, your tiers are 1 to 3,000, 3 to 5, and then over 5, I think. And then on your sewer, I think it's just 1 to 5, maybe.
Yeah.
I think there's one lesser tier, but is it the same? Okay. And then you've got your inside residential, your outside residential, your inside commercial, outside, all those different. So within the model, you can look at, well, let's just do 5% on the residential customers. But if you think about it like this, however much you downsize the rate increases on those, you're going to have to offset it with a higher on the others. And so again, that's very much a board decision as to kind of where you want to put that rate increase.
I'm pretty sure this board wants to find a way to ease the impact on our lowest income. And, when you look at 52,000 as lowest income, poverty level, we need to find a way to reduce the impact on those who are least able to pay, while also achieving all of these goals.
Right, no, it's,
I mean,
Magic.
I'm sure we all agree with that. The problem is, of course, there's no correlation between household income and water and sewer usage. So I don't know. I mean, you can have one person
Usage,
household.
but ability to pay for your usage.
I'm not sure I understand that, but okay.
No, I think we need to kind of refocus. I mean, merging with the county is downstream, so to speak, and what that effects will be. But what we need now is to look at the model that they have presented, and what is the best model that achieves success for the funding of this project. So the county has a commitment from the city so we can rebid this. and then acknowledge the fact that those with low income, what can we pass as a board, what you can pass as a board. I mean, you have free reign. You can decide that we're going to put money into the system, that someone with a certain income, that we're going to supplement or in some way or decrease, or there must be some way that can be done. I appreciate that from Reverend Alderman Lowe Davis, that important point. But I think we need to get back to what is the best model to achieve the goal so the county can move forward, so Southport can move forward, because this is something we have to do. I was talking to a good friend yesterday, and he was asking about the city, and he said that in terms of this issue, the sewer, he said, y'all have kicked the can down the road so far and so long, there's no can left. So this is something that we really, yeah, it was good. And notice I didn't take credit for it. I gave it to someone else. So I wish I was that witty or clever, but it's true. And so that's where the board is right now. What model, and we don't decide today, but continue to ask questions, to continue to think about it. Thank goodness the county manager is here for their insight, and our finance officer. What is the model that will bring success? And that's why these advisors are here and these consultants. What is the best way forward? Because as the city manager says, the longer we wait, the worse this is going to get. The worse it's going to get. I mean, with interest rates and that type of thing. So now it is time to do this. So any further questions, comments, conversations?
I have another question. I don't know if y'all are familiar with Oak Island. I believe, and somebody correct me if I'm wrong, but what I think is that they have an annual $600 per parcel assessment. And so that way because you're having to have the availability and you're structuring everything based on being able to provide that service. So is there some anomaly that allows them to do that versus, because then how you're paying it and interest rates and all of that may be some difference?
Sure. No, we don't work with Oak Island, but I'm familiar with that. That topic came up when I was, as I mentioned, a somewhat similar situation we're looking at with a different client. I think they charge an assessment to those, and I believe it's for a 10-year period. There's a couple of different ways you can charge assessments. I think one way you can do it over 10 years, and it maybe requires a lesser threshold for approval from property owners, or maybe it doesn't require any approval from property owners. If you wanted to go 30 years, I think you have to get certain approval from that. But yes, I mean, that would be another, it's not, to my knowledge, widely used across the state, but I am familiar with that. That could be a avenue to go just to generate an additional revenue. So that's obviously not something you currently do, but if that's another path to generate additional revenue, I don't know you have to think through the pros and cons of doing that versus the rate. I mean, at the end of the day, someone's still paying it, and so is that better?
I think one of the primary reasons they did that is because at the time they had so many vacant parcels. I mean, because I think they instituted that when they first got the sewer system up and running, and that's been a good while. It was way before COVID. And I think they wanted, the primary goal was to, have the vacant owners of the vacant parcels participate in the cost of extending sewer.
Remember the people with second homes here in Southport, they would cut their water and sewer and then want to be reconnected, and they didn't want to have to pay for that in between. And we finally had to explain and send out a letter that everyone has a basic monthly fee to keep the system going, regardless if you're there or not.
The things when we first met with Walter and David, as I said, could you take a look at our rates and make suggestions? But that's a separate thing. They can, but that's totally separate from what we have to do now.
Sorry, a base rate without any usage baked into it, and so that's, you know, you could look at different rate structures as well, tiers or otherwise.
I have two other things. Melanie, can we get a rate projection based on 1,000 gallons per month? We've got one based on 4,000. Can we get one based on 1,000 so we can see what the impact is on the smallest users?
Okay,
And
so,
I don't need it right this instant, but
okay,
if you
all
can
right.
give it to us at next week's meeting or
Okay.
something, be great. And also, so doesn't this, this isn't a question for the Tryon folks, but the system development fee is based on our costs, right? I mean, so because of the fact that this expansion project is now basically twice as big as it was, doesn't that give us the opportunity to raise the system development fees?
Yes, and it's also time to have a review of that structure.
Mm-hmm.
Yeah, we're required to.
I mean, we could
every 5 years, and
significantly,
it's
we could
time.
significantly raise system development fees, I would think. And I would think most of our current water and sewer users would probably want us to, in order to make new users pay what you might term as their fair share of the cost. And it does seem like to me that if we are able to increase that system development fee significantly, that we should capture that in the model and you know, make plans for using it. I mean, I think that might be a way to actually reduce, at least a little bit, the monthly fee increases.
Factor any of that into your assumptions?
We did not. We've just kept your system development fees static, the flatline those. We haven't kind of gotten into that. That's honestly kind of a niche business on the system development fees and the formulas and what you can do and can't do, and we actually don't do anything on the system development fee side. There are entities out there that do that, but that would be, you know, I agree, something that you could absolutely look into to see if those could go up to pay for that.
We've worked with our engineering firm, I think, in the past to determine those rates. So. We could get some kind of preliminary information on what that might do, you know, what system development fees might be able to be raised to. It would be a helpful part of this conversation.
How soon do you need to make a decision?
Informational only today. Our decision will be once it's put on the, yeah.
For timing wise.
We really, we will all end up under a sewer moratorium if we don't move ahead. So we need to get back out in the marketplace within the next 60 days or so. When you shared this report with me yesterday, I shared it with our finance officer, and we're going to take a look to let you know, part of our existing agreement essentially says that if there's some part of the expense you can't finance, that we would consider a rate differential for Southport, which we don't like to do, but we could do, and we'll do an analysis and tell you what we think that would look like in costs back to Southport versus what these numbers look like. But I say you give us your best judgment in short term, and we'll get it back out to market, and we'll see. I mean, you know, we don't know. It could go up, though. Frankly, looking at those numbers, I don't really see much room for it to go up, depending upon how busy the contractors that are capable of doing this work in our region are. It certainly could come down, though the state is not giving us a lot of encouragement for the next 3 to 5 years, because primarily all the federal funds that are out for infrastructure right now.
Hanover's getting ready to build a new, or just beginning the process of building a $250 million wastewater treatment plant.
Yeah.
And I'm sure lots of other people around us are too, so there's going to be a lot of activity.
I guess in answer to your question, Alderman Davis, I would say the latest, because I know usually you won't vote unless it's a regular meeting, so I'd say it's your meeting in April.
I have a question. I don't know who to, I'll just put it out there and whoever can answer it. So if we decide on a plan, a financial plan, we agree, I mean, let's just, for sake of argument, let's say, okay, we're going to do this. And the county goes out and bids the plant and we're all moving ahead. Do we have the ability to change our plan 6 months from now or something? Let's say we do get another USDA loan, so then we lower our borrowing, we don't have to do the other bond or whatever. I mean, how much leeway do we have to change things, I guess?
So there's in terms of the schedule, it's really driven by the timing of the construction bids. If you go out and bid that project again and you get the numbers back and you've got a 60, 90, 120-day window to accept those, I would assume y'all wouldn't want to accept those or wouldn't tell the county to accept those unless you had your financing on track and in place. And that means getting approval from the local government commission. And so if we're advising you, we would say don't accept the bid until we know we've got the financing approved. And so to get the financing approved with the local government commission, A, they're going to want to see your construction bid in hand so they know you have a firm cost. But B, they're going to want to see your plan of finance. How are we going to repay this debt? What does that mean in terms of our rate increases? If there are system development fees out there, they will dive into this analysis too. Rating agencies who are going to have to rate these bonds when you go out to sell them will dive into it. Investors will. And so you need to have the financing schedule, the financing plan in place before you, or at least on track to be approved and in place when you get your construction bids in, so that when those construction bids come in, the board can approve the revenue bond financing, the local government commission can approve it, and you've sold the bonds, locked in your rates, and then you can accept the construction bid. All of those work together. That said, if you go down that path and say, here's what we plan to do with our rates going forward, and then you decide after the fact to increase your system development fees and lower your others, you can do that kind of after the fact, change maybe how that is. I think you would want to, the local government commission may say, well, hey, as long as the picture in results the same, we're okay with it, but don't give me a bait and switch here. Tell me you're going to do one thing and then do something else. So we'd have to guard against that. What you wouldn't be able to do is once you issue the revenue bonds, you wouldn't then keep applying for state revolving fund awards or USDA because you're locked into your debt. Once you issue the debt, you have the debt. So I guess we'd advise you, don't get the cart too far ahead of the horse with the construction side until we know what the plan of finance is on this and what that means in terms of your rate increases.
think, I guess I was thinking more about on the revenue side, just our ability to, basically what you're saying, we're not going to be, we agree we're going to, raise rates X percent.
Right.
We can, if we find another source of money, then we can lower those rates as long as the bottom line is all
Right.
the same, right?
Right, and the typical financing process for a revenue bond issue, and I would extend it, it's normally about 3 months, I would extend it to 4 for y'all, first-time revenue bond issuer, heavy lift on the front end. The local government commission and the rating agencies, bond investors, that's the group I keep referring to, they're going to require what's called a feasibility report, which is really dives into all of this. Here's how you've been historically, here's what we're looking at, projections, here's the assumptions on customer growth. They're going to require all this detail in order to approve your financing, and so that takes some time to kind of formalize and put into a report. And so that, again, I'd say a roughly 120-day process for a revenue bond financing. Once you all say, yes, we want to move forward, start that up. And so within that 120 days, we would ideally be timing the receipt of construction bids for that project around that 90th day time frame. So you get those in, we know, or maybe more like the kind of 60 to 75 day time frame. So we know what the number is that you need to finance, and then we're getting the final approvals and selling the bonds. And so that's built into that 120 day time period.
I'll put together a tentative schedule so that you can see how this whole thing works. So I'll work with them and with the county to put that schedule together. Because I'm learning a lot here too, so.
Question, from what you've seen, do you anticipate that we would have any difficulty selling the bonds?
No difficulty selling the bonds. I think as long as the plan of finance is sound and it shows you have the revenues available to pay it, the project itself is understandable. I think, and the pledge is strong. At the end of the day, this is an essential service. The ratepayers are going to keep paying their water and sewer bills. They pay their property tax, they pay their water and sewer. Those are the main things they're paying. So it's a very secure revenue source. You will have, with this structure, a rate covenant in place that I mentioned earlier that requires the board to raise rates to whatever level necessary to generate that certain coverage level. So there's protections in place for the buyers of the bonds on that. Where I think you would get some questions, and I don't want to say pushback, but you'll get some eyes on it, is just the size of your bill with all these rate increases versus your peers. The local government commission, I think, will focus on that. Rating agencies will look at it as well, like, hey, y'all, if that shows that you're kind of outsizing your peers across the state, the question of affordability comes into play, and so I think you'll get some questions on that. I think that's fair. You'll still be able to sell the bonds. Maybe it's at a little higher interest rate, a little bit lower credit rating because of some of those facts.
Does the fact that we're trying and hopefully will, in the not too distant future, have our system taken over by the county play into that at all? I mean, will they take, is that worth mentioning in the bond in the application?
So you have to disclose anything in this offering document, anything that's material. And so if that's been discussed in a public setting about the potential merger, that question is going to come up. I don't necessarily think that's a good fact for you all if you're trying to sell your bonds and people are buying 25-year bonds, and the noise out there is that you might get merged into a different system. That's just some noise out there that I think you'll have to deal with. You'll get questions on that. And so I don't know if I wouldn't say that's viewed positively. I don't want to make it sound like it's negative either, but there's some noise around it if that's the discussion out there, because again, bondholders are buying it for 25 years based on your financials. Now, if some may look at that and say, well, hey, if the county takes it over, their financials may be a little bit stronger, credit a little bit stronger, maybe that's a good thing. So some may look at that. I haven't thought all the way through that. Do you have any thoughts on that?
No, I think we'd want to understand the likelihood that you believe that merger is going to happen and the timeline under which it's going to happen. If you said it's 100% certain and it's going to happen in the next 12 months, I think that opens up a totally different range of possibilities of, well, how do we do some kind of interim financing if we know that? If you said it's 50-50, and if it happened, it might not be for another 5 years, and we need the expansion right now, then we gotta blaze ahead. So some of that is just feedback we would need from you all in terms of timeline and likelihood of that.
Yeah, it's called a merger feasibility study up front, and secondly, it'll be years because we have to upgrade our system to a point where they will accept it.
Right.
And so that's a distant issue. It's a goal in the distance, but it is a goal. But the primary goal right now is to, find the funding to pay for the expansion, to work with the county so we can get that plant expanded and that we are able to fund it properly in different modalities and in a collaborative way.
Is it possible and Steve, I'm not going to put you on the spot, but if the county can get a better rate and all of that, can we not figure out a way, if it did go this bond route, to go and have the county do the second portion of it without us trying to get our own bond at a higher rate, if we can work with the county? Because we do believe that this will be a county system eventually, and you just brought that up, that if we couldn't get it, but with these rates, if there's anything we can do to try to mitigate the rate increases, then that, I don't know if that could be a conversation with Bonnie, with Steve, with the county.
I've asked our finance officer to give an analysis, and just as an example, if the county essentially financed 25 million of it, what the charges back to South for that.
I think the other question that I have too is, we don't own this asset, and could that cause issues? I'm used to, you go to bond, you own it, the city owns it. We don't own it, they own it. And I don't know if that's going to cause problems with the LGC, or somebody says, well, what are you taking out all this? You don't own that thing.
Good question. I don't know what the LGC's reaction would be to it, since it's, again, not part of your system. It's obviously for your system, for your ratepayers, for their benefit, and so I don't see a legal issue for it, but it's a good question. I mean, that would be something, again, we're not to run by your a bond council and the LGC to see if, hey, is there a legal issue with doing this.
We do, of course, have a contract with them for, is it 20 years or something, what, 40 years? Yeah. Think that would, satisfy them, but.
Would you own, would they own that portion of the plant, or are you buying capacity in the plant?
There's an existing regional partnership agreement, and Southport would become a partner like the other entities, which are the town of Oak Island and the town of Holden Beach. I don't think they had difficulty getting the financing for their shares under that agreement.
Okay. One little wrinkle to think through, for the lawyers to think through, is the use of system development fees. This came up in this other matter I keep referring to. The use of system development fees, if you're not acquiring ownership of something, can you use it for capacity? That came up in this other instance, and so we actually had to pivot and had them acquire ownership so they could use a portion ownership of a plant so they could use system development fees. So that's where the system development fee language and that's a very specific topic that somebody would have to dive into.
So there's no parallel universe. We can't be trying to get another state loan at the same time we're tracking to do a bond.
So I think you could do, depending on the time you have, I think you could, with this next application period being in May, I think you said it, Melanie, You could apply again for that. If you wanted to then take the time to dive into the system development fees, and, you know, that will take a couple of months to kind of go through that process and see how much you can increase those. Can you use them for something like this? And so if you said, we're going to do that anyway, we'll spend a little bit more time on this rate component aspect of it too. So that's going to take us a couple of months. We might as well apply in May, see if we find out a few months later. I think you would find out in August. And so looking out over the next 6 months, let's get everything in order. Let's evaluate system development fees, dive into this, the user revenues as well, and use that time to apply again and see if you can do that. If kind of realistically, we know it's going to take several months just to go through that side of it, might as well apply and see. You're not really losing out on anything, and that would make it August. You would know, did we get any additional award? If the answer is no, we still have the, you know, by that time you've got the plan in terms of what the SDF revenues could look like, what those would go, and you could kick off the revenue bond financing from there. Is a thought. That assumes you can wait that long, you know, essentially wait to the end of the year to do the project, because it's going to take as I mentioned, that 120-day time period from when you say go on the revenue bond financing. So if we're waiting till August, you know, you're towards the end of the year. Not to go down this rabbit hole too much, but after October, the LGC will not approve of financing until you have a new audit, your fresh audit. And so depending on when you get your audit, when that is finalized, Melanie, when do y'all typically finalize that?
Well, the goal is October 31st, and we did miss it this past year, but we have been on target in the prior 3 years for that. So
Okay.
hopefully we'll be back on track this year for October.
So you could be in a position in December to get funding, maybe, you know, January, but I know the months quickly go by with all that, but that is a path you could go if you wanted to explore.
I know we're just thinking out loud about this, but if the county said we need to be ready to start construction earlier, could we dual track the SRF application and a revenue bond, either that the county's going to issue or Southport, and just know that if you are lucky and get the SRF, if the county were issuing the debt, you'd have some legal costs that you'd need to reimburse them for, same if you were doing it on your own, and kind of position that when you hear back from the SRF, that's the best case for everybody, county, you. If you don't hear that, then you're ready to close in September if you got your construction bids back in, say, July or August. And I don't know how long it takes to rebid it, but I was kind of watching your body language, dragging to December or January. Okay, I was interpreting it correctly. So maybe a dual track that would let you, again, you'd be at risk for some legal fees and staff time, but you could, if you get the SRF, jump on that. If you don't, you've already gotten underway with the bond issue, feasibility study, credit ratings.
And this is coming more on the forward. The SDF, I think, is important to look into that as well.
System development fees. Yeah.
System development
Yeah.
fees for the usage, permitted usage of those for something like this, as well as any revisions to it. I think y'all would be smart to look.
Yeah, I think a lot of those questions will help be resolved by the county's finance director looking at this stuff, and then staff having some discussions about what the timing needs to be.
Thinking out loud, Dave, correct me, but on a $25 million borrowing, if the county's borrowing costs were 100 basis points lower, which would be very generous, I think it's probably not that much. That's $250,000 a year in lower interest, give or take.
Yeah, I think so.
So it's not, I don't want anybody to think that if the county borrows, that suddenly it's going to be free. I mean, the county can save you money, and that would be great. We all want to save money, but, sorry. I think I have it on, I'm just not talking to you. I'm so sorry. That's all right. Okay, thank you. So if it were 100 basis points, and it's probably more like 50, you're probably talking about savings of $125,000 to $250,000 a year by the county being willing to borrow for you. So it helps, every little bit helps, but it's not like that's free money.
Pretty soon you're talking about real money.
Right.
Time versus money issue. I mean, time is a factor. And so listening to Mr. Stone, you know, we really want to move, we want to get it right, but we also have a time factor involved.
And so what the county needs from us is to know that we're still going with the can you clarify, or how we're financing? Tell me.
We need to know that, you know, what you think your ability to obtain financing is. And we're 2 years behind right now, honestly. And I hate to blame so much on COVID, but COVID had so many impacts, not only in construction industry, but in the state's ability to move things down the rails too. And, you know, I certainly don't want a recession. Currently in construction, there's no sign of a recession in Brunswick County. And if we don't get this expansion underway, we will come to a point the state will have us put some brakes on connections to the whole regional system. And I know none of us want that for that reason, unless somebody makes a conscious decision to apply the brakes. And so we need to know, and you know, our if in essence Southport is using the county's excess capacity now, and we really don't have excess capacity now. So it's in all of our best interest, you know, to just get a confirmation from the city, give us, you know, your best judgment on what you think the city can come up with, and then we need to find a rapid path to get somebody under contract to build this expansion.
Further questions or comments?
Just want to, does anybody want us to look at certain assumptions or change some assumptions?
It would be helpful for me if we had all of these variables had a timeline. If, you know, you could show us the whole bond process in a timeline,
That's the schedule.
the loan, you know, if we did the May loan, just all the different things, getting the new system development fee study, just all of those.
Yep, that's on my list. Tom and Tom, the two Toms, do you feel, are you okay with the assumptions? They look good to you? Anything you feel needs to be changed, or?
Bonnie, I think adding to the list would be helpful, just to have another, I know you've had initial conversation with LGC staff, but having another conversation with them coming out of this and kind of what we're looking at. Can we dual track something? Kind of what ultimately, are you going to push back on us if our, you know, our rates, ultimate rates with all these increases would be, you know, this level, get some feedback from them, and then also talk with a bond counsel firm on the question of the usage of the system development fee revenues for this sort of project. I think having some of those legal questions put to bed too, so we know we're not going down a path that we're going to.
Will get rejected.
Right.
Do we have a timeline on when the rebidding will take place and the completion of that rebidding?
We're waiting to hear all that review.
Okay.
We really need to get it advertised within the next 60 days or so, and probably at least 45 to 60 days after that.
So conceivably, we could be actually in more debt because the rates could have gone up.
Say that again, I'm sorry.
The
Well,
total
no,
cost.
if the bid goes out and instead of the lowest one being 47 million, is now the lowest one is 53 million. Theoretically, we could be even
And
in a deeper hole.
I think there's a good chance that could happen.
Yeah.
Steve, do you recall, did the last bid have a 90-day acceptance period, or I feel like that's standard, but
The last one had
60 days?
I think it was too.
If they had continuing to pump up rates, if we asked for a 90-day, that may adversely impact
Right,
bids.
right.
Anyone else? Any other questions?
Also include the concept of an assessment, if we understood how many vacant properties and that sort of thing, if we, maybe it's all of the above.
All right.
A question on that. Oh, sorry. I thought they were mine falling on the floor. If we are thinking about an assessment, did you say of, I got it. Oop. Okay. About assessments. If the assessments would be on vacant properties, on the assumption that these are going to cost more, or? what?
All properties. It
All
would have to, it
properties.
has to be on all properties.
I see.
Every opportunity for revenue needs to be looked at, absolutely. And Pro Tem, thank you. So we'll go to item F. Are there any further board comments or questions? Alderman Allen? Alderman Alt? Okay. Alderman Davis? Okay. Mayor Pro Tem? Okay, thank you. And this has been an excellent meeting. I think we all have a lot to digest. City staff has a lot of work to do. Thank you, City Manager, for arranging this. This is, it is complex, but it's also straightforward in that we need to find a way forward for the funding for this project, for this wastewater treatment plant expansion. We need to give the county our commitment so they can move forward with the bids. Mr. Stone, thank you for being here today and helping us through this. Consultants, thank y'all so much. Pleasure meeting you. Thank you for such an excellent presentation. And I know we have our homework to go over, and we'll be having further dialogue, and city staff will be on it as well. And thank you, Cheyenne, for the telecommunications to our citizens. I will, yes. So thank you all for being here today. Excellent meeting as we move forward. I'll entertain a motion to adjourn. Mayor Pro Tem, is there a second? Second by Alderman Allen. All in favor? Motion carried unanimously. Thank you.